This podcast is intended for investment professionals only. All investing involves risk.
Hello and welcome to this special podcast to mark the publication of our 2026 Global Outlook, which offers key views across public and private markets after yet another remarkable year for investors. I'm Max Julius, Head of Content, and I'm delighted to be joined by a panel of expert speakers. On that panel are Sonja Laud, our Global CIO, Christopher Jeffery, Head of Macro Strategy, Rob Martin, Global Head of Investment Strategy and Research, Private Markets, Colin Reedie, Head of Active Strategies, and joining us from Chicago, but here in our London office, we have David Barron, Global Head of Index and ETFs. Hi, everyone, and welcome to the pod.
Thank you very much.
Hey, Max.
Well, with no further ado, Sonja, which investment themes strike you as the most profound of 2025, and which ones do you think will drive markets next year?
So where to start and how much time do you have? So first and foremost, thank you all to all our listeners to joining us again. And I've been looking back actually and have been listening to the podcast that we have recorded exactly a year ago, trying an outlook onto 2025. And it's interesting what we have mentioned. I remember I said, is it US exceptionalism again? Because clearly 2024, we've talked a lot about the superior economic growth, earnings growth, equity market performance. So everything was pointing towards another great year and a continuation of the US dominance. We did mention that the risk of policy decisions was increasing on the back of the re-election of Donald Trump, and that markets would find it difficult to price policy decisions correctly. Now, we will come to it in a minute, how this has turned out. We did mention as well, and Colin was the one who brought the term up, of fiscal incontinence, and that clearly is a topic that will come back a lot more going forward and where we've learned quite a bit throughout 2025. So in a nutshell, what a round trip 2025 has been. What made 2025 exceptional? First and foremost, exceptionalism expressed in the US by the level of executive powers the US president has, and to date, 217 executive orders were signed. We know now that executive orders, once signed, can be changed, and we still wait for the Supreme Court to opine on the legality of the majority of the tariffs imposed by the Trump administration. Despite all of this, the US economy has proven more resilient, and US growth and earnings have yet again outperformed most of the developed world. But US equities are set to underperform the rest of world equities in 2025, despite their superior earnings growth. And it is because of the rating, i.e. the multiple expansion everywhere else, rather than the superior earnings growth of other countries. AI has clearly been at the center of every investor debate, and it will remain so. What is interesting for Europe, though, is they have outperformed despite a negative 1% earnings growth. So it's a very interesting mix. And if we put this all together, we clearly want to make sure that we're putting it in the right framework into 2026. Other noteworthy events, clearly, Japan has elected its first ever female prime minister, and we'll have a look at the fiscal policies that have been put forward in the context of fiscal incontinence. Even more important, and coming back to the Rheinmetall story, Germany has softened its constitutional debt brake and has put forward a historic defense budget to rearm the country and Europe. And on a maybe more lighthearted but equally serious note, French managed to get through 7 prime ministers in 2025, and the year is not out yet, so there is the chance to probably have one more over a controversial budget that aims to reduce the budget deficit. So despite the lightheartedness, there is something very serious in there, because of course budget deficits and the unwillingness of governments to address budget deficits clearly has been another topic for 2025. So what are we looking out for in 2026? To start with, most conventional cycle indicators point to another year of reasonable growth. So there's not a lot of warning signals on the horizon. Central banks, interestingly, are expected to either do nothing or ease, with the exception of the Bank of Japan. And that is interesting, of course, because that raises the question around inflation again and how markets will try and juggle that balancing act. On the side, and we should never forget this, the war in Europe is still ongoing. We still have trade policy uncertainty, and we have Fed independence, despite the fact the debate has died down a little bit. But in 2026, we're, of course, looking for quite significant changes at the top of the FOMC and with regards to its membership. So I know we have a lot of experts here that will go into greater detail of the individual areas. But there's three key areas that we're using to shape the debate, because these are, in fact, goalposts that have been shifting that not necessarily will influence just 2026, but to a large extent have far broader implications over the longer term. Goalpost number one is the continuation of the geopolitical shift. And I think what we've learned in 2025 is the speed with which the US has withdrawn itself has been quite an extraordinary experience, and will, of course, accelerate this idea how we move towards a multipolar world and how this world will find a new equilibrium, if at all. And there will, of course, be consequences how companies will look at their own setup, the way they operate, what allies actually mean, and as such might well have profound implications on asset prices. The other one is the idea of invest like a government, i.e. you look for the strategic sectors that are very much at the center of attention for governments. Energy security and defense are the key ones that come to mind, alongside, of course, digitization, AI infrastructure, i.e. the overall establishment of the right infrastructure within a country. The second one actually is interest rates. And you might say now this is not new, but I think the important one is that interest rates will not come down to levels that we got used to prior to the pandemic. And that is important. Not so much that we fear that companies or households will be under pressure to deal with higher interest costs, but it's governments that have seen the most dramatic increase in interest costs. The most significant number that I like to use is that the US is now facing up to $1 trillion in interest costs. Why is it so important? Because that's goalpost number 3. If you think about the pressure on budgets and budget deficits, the pressure on upward pointing debt levels, then interest costs do matter, because they're an increasing part of the budget deficit. And of course, the more debt you're piling on, the more interest costs you will have to be able to accommodate. And as I said just now, the unwillingness of any government to address this ever increasing spending, and of course, in the context of the level of income that is not commensurate with the level of spending. Again, looking at the United States, the expectation is roughly for a 7 trillion expenditure budget versus 5 trillion of income, and with no real measures in sight how you can reduce that 2 trillion gap. Why is it important? And I'm sure Colin will pick this up, or even Chris, the bond market will take note, because if debt levels will continue to rise, then eventually investors will worry about the value of the investment in the future. And as such, the term premium, i.e. the risk premium attached to investments in government bonds in particular, will potentially rise. Now, that brings me neatly to the role of AI, because how can you break that doom loop is higher growth to a large extent. And not surprisingly, growth has been the main topic that most governments have put forward in their either recent budget announcements or in general. And how do you get out of a rather mediocre growth backdrop? That's particularly true for Europe. AI, of course, points towards a very neat solution in the context of AI driving productivity growth. Now, it's very, very well understood that the US potentially is in a pole position because they produce most of the hardware. China is seen as the other country that has spent enough to rival the technology and progress that we have seen in the US. But nevertheless, we are now aiming to understand how we can see the narrative moving from the enablers to the deployers, because that's at the end of the day what you need in order to get to productivity growth. So the market will try to grapple with all of this, but the way we have tried to break it down is it gives you an indication where the goalposts are shifting and how they might influence the overall economic backdrop. And this is what I said right at the beginning. Right now, there is not a lot of concerning factors on the horizon, but just understanding where they might come from will come very handy in 2026.
Well, thank you very much, Sonja, for that comprehensive overview of the round trip for investors, for markets this year, and key themes, those shifting goalposts for investors next year, covering geopolitics, rates and debt servicing costs, and of course AI. Sets us up very nicely for the rest of this call. Chris, in light of Sonja's comments just now, what's our base case for the global economy, and what does this mean for assets allocation?
Thanks, Max. And I'm going to actually start where Sonja finished. So Sonja was sort of talking about a US outlook, which is not too concerning. Financial markets always tend to hang off what happens in the US, and the rest of the world kind of goes along for the ride. I describe the US outlook as the 2-2-2 scenario, 2% growth, 2% inflation, and frankly, too boring to spend much time talking about. So instead, I thought what might be more useful was just talk about three pivotal issues for financial markets in the year ahead and how we're thinking about those. And unsurprisingly, they're going to cover some ground that Sonja's already covered. And unsurprisingly, again, I'm going to start on AI. So I'd say that if 2025 was the year of kind of learning about the size of the capex for AI, lots of big numbers flying around, 2.5 trillion up to 5 trillion, even sort of 7.5 trillion number floated at one point. 2026 is the year in which we discover whether there's a pathway to monetization. So on our estimates, we need to see ultimately global revenues in excess of $1 trillion per annum by the early 2030s to validate the scale of capex that we've seen or we've seen announced. That's plausible, but let's just put it in context. That's $50 per month per citizen in the OECD. It's a lot of money. That pathway runs through increasing consumer and enterprise adoption. It runs through embedding advertising alongside subscription models. A lot's got to go right, but it can go right. And I don't want to be the person who's kind of like ringing the AI bubble bell here. We've definitely got some qualms about this, but NVIDIA's derated consistently since we've been talking about AI as a kind of investment community. Since the day that ChatGPT was launched, NVIDIA's gone from something like 40 times forward earnings to 25 times forward earnings. So it's not a massive hype cycle that's driving valuations up. It's largely been a story of revenue delivery. So I think AI monetization, 2026 is the make or break year. And then a second issue in which I think 2026 is the make or break year is on US fiscal. Colin's talked about incontinence. I'll just talk about sanity. Can we see a kind of a realization of kind of sanity here? We've got midterms in November. Republicans are currently 6 points behind in the polls. How do they react to that? Governments which are behind in the polls often throw money at the problem. We've seen the discussion about $2,000 per citizen as a potential policy for next year. We saw in 2020, 2021, large cash handouts tend to drive up prices. It's not particularly complicated economics. And the bond market really would not be very happy if we see a repeat of those kind of large cash handout policies. It's one thing to do it in the middle of a recession. It's another thing to do it in the middle of a kind of normal expansion for political reasons. We think that's a very non-confident statement. We think Congress will hold the line and not allow that kind of giveaway, but who knows? And we've learned so many times in the past, if the Treasury market sneezes, the rest of the financial markets get pneumonia. It's not about like catching a cold; it's sort of more seriously unwell. So you've got to be watching developments in Washington closely. And then area number 3, again, it's one that Sonja's talked about. Is 2026 the year in which finally we see the end of the conflict in Ukraine? Don't know. Don't expect a sudden outbreak of seasonal goodwill this time of year, given the intractable differences. But the war's got to end at some point on terms that we don't have not yet been defined. The point I just make there would be, if it were to happen, it would be pretty seriously good news for Europe, given the higher energy cost structure of European manufacturing relative to the rest of the world. I guess mixed implications for what you might think it would mean for the equity market, given the European defence and fiscal stimulus hopes more broadly would presumably, we'd have to kind of rethink what that trajectory looked like. But the bigger implications, I think, would be on the relief of the pressure on the energy price side.
Okay, thank you very much. My takeaway is around the conflict in Europe, the not going to say, well, I will say incontinence once more, but or catching a cold, or the fiscal fault lines we've all been discussing. And,
Very well put.
thank you. And so, look, you're not being a Cassandra, but you have articulated clearly what exactly has to go right to reach that pathway to monetize AI. Rob, Chris just touched on the AI-driven CapEx boom, which is being funded, of course, by both public and private markets. How can private markets investors manage the associated risks and opportunities?
Yeah, it's a great question, Max. So for private markets, a lot of the activity associated with AI CapEx has been in the real asset space, and specifically data center development. I think you can be very bullish on AI as a theme, as an asset class, and its wider economic impacts, but also thoughtful about the pace of demand and the possibility of some pullbacks. So there's a few things to think about to manage that in the context of private markets. And I think the way we're thinking about it is to see data centers as part of a wider digital infrastructure space. And there's some diversification angles around that. The first one is geographic. A lot of the data center development has been in the US, vastly the majority of it, actually. We think it is well worth complementing that with some European exposure. And Sonja mentioned the US is establishing a very big leadership position around a lot of the technology here. I think as we start to look more from that model training to deployment, you're going to start to see more data center capacity be needed more broadly as firms and individuals use them. There is also a big angle, particularly in continental Europe, around data sovereignty. And a number of countries are looking to see data and compute capacity held domestically. That's a big driver in Europe. The second thing is to think about within data centers. AI is the most recent thing, but it is not the only thing that drives demand for data centers. There is still a huge consolidation process which is still ongoing around cloud computing. Many businesses still are working off old servers hidden in rooms. There is a big trend towards moving that out of offices and into purpose-built facilities. That is actually one of the big drivers of data center demand. So making sure that you've got assets which can serve multiple purposes is another way of diversifying. And then the third thing is about thinking about digital more broadly. So data centers is a big part of the universe, but equally, we are still in the midst of a 5G rollout. We are still needing to lay down fiber. There's now talk about more space-based communications technology. So seeing it as part of a broader infrastructure set is another way that we think about it. So where we come to is the idea that you can have exposure to AI and digitalization, but if you do it in a broader way, you can arguably create some resilience against some of the inevitable, corrugation that you're going to see in the AI theme specifically.
Colin, I'm sure our listeners would be keen to hear your take too on the CapEx question from a public credit perspective, and how do you expect the debate over debt sustainability to evolve next year?
Thank you, Max. It's been an interesting process preparing the sort of seasonal outlooks and the year ahead stuff, and then putting some initial thoughts down on paper. I noticed that when I got to the end of it, at no point did I mention growth, inflation, monetary policy, or any of the other usual drivers you'd expect to see in these kind of sort of research pieces. I'm not 100% sure what that tells us, other than that next year seems to be all about AI and sovereign risk, as we've already referenced quite a few times on the call. The key here, I think, and most investors know this, is that the AI capex numbers are just huge. So big, in fact, that they come with macro significance, what we've termed macro significance for the US economy, obviously, but also more broadly, as we're talking about a global theme here. So I find it hard to get too bearish on US growth expectations when most of the AI capex benefit is still ahead of us, yet to be felt. So as the debt gets raised and then deployed into the economy by the big tech firms. Another factor here that doesn't get much mention, actually, is that US bank deregulation is about to begin, nearly 20 years after the GFC. And any student of cycles, the booms and the busts, will tell you that while they all differ, we tend to get ourselves in bother around every 20 years. So does that mean we're late cycle or approaching it? If it is, then we need to acknowledge it in our risk taking, because the odds for the investor change, and significantly so, depending on where you are in the cycle. But what interests me most actually is the circularity to all of this. My co-head of global fixed income, Jason Shoup, has spoken about the fact that to date, the hyperscalers have financed this investment through their own cash flow, alongside a very willing sort of private credit market, as we've mentioned. Going forward, the public markets are going to have to step up because the sums involved are so much bigger now, and the tech sector needs to sort of broaden out its investor base as well. We got a little taste of what this might feel like in October and November, when in relatively short order, we had to swallow $85 billion worth of issuance from Oracle, Amazon, Meta, Google, and Dell. And there was some indigestion, which has passed now, to be fair. Most bonds, ex the Oracle issuance, currently trade modestly tighter than where they were issued. But we have Microsoft next, and that could be as much to another sort of $25 billion. So back to that circularity point, if there's any sign that credit markets aren't willing to finance this, or just step back because these companies are not spread sensitive, by the way, they want the money for the bigger picture and they're going to pay whatever they need to get it. An extra 5-10 basis points does not matter in that context. So if the debt comes cheaper and cheaper, upsetting the owners of who bought yesterday's deal, then credit investors could step back. And so anything that highlights the credit market's capacity being lower than expected, then that AI capex tailwind for growth might not be so supportive. But here's the thing, it's not just the AI tech sector anymore, it's actually corporates more generally. M&A, having been at its lowest level in over 30 years back in 2023, is back. Third quarter announced volumes were up 43% year on year, but crucially with large strategic transactions leading the way. That tells us that corporate confidence is back. So to the point on the stage of the cycle, one reason you can sleep well at night as a credit investor is when M&A is not a big thing, because it's always when balance sheets take on more debt and credit ratings are put at risk. But it is back. And we even have a classic headline grabbing one in the press right now in the media sector with Paramount going hostile to acquire Warner Brothers Discovery. This is only going to fuel the comparisons with between the current cycle and the late 90s .com bubble. I'm sure some of you will remember AOL's disastrous takeover of Time Warner in early 2000. I certainly do. And finally, we get to governments. Most who listen to these podcasts will have heard me bang on relentlessly about the sort of paradigm shift from monetary to fiscal policy. But the thesis is very much alive. You know, as we leave 2025, we have Germany and Japan joining the fiscal as fab club, which I hope sticks more than fiscal incontinence for next year. The former releasing their debt brake, as Sonja's mentioned, and the latter electing a very pro-fiscal Prime Minister. And, you know, this is on top of the one big beautiful bill in the US, and that's before we even get to France, as we've discussed. So the challenge I get, the pushback from the team I get, is that fiscal sustainability is well known and understood by markets. I don't disagree. The point I'm making is there is a plausible path now, I think, to a crowding out theme developing in bond markets, because issuance is going to be coming at us from governments, from corporates, the hyperscalers, and the numbers are just enormous.
Thanks, Colin, for talking through the implications of those huge numbers, some of the risks there for credit investors, and for offering that long-term and somewhat sobering perspective. Dave, we would be remiss if we didn't dig a bit deeper into concentration risk. Just how concentrated are the US and global equity markets, and how can investors aim to manage this?
Excellent. Thanks, Max. One of my favorite questions, mostly because we get so many inbound inquiries on this exact topic from clients wondering, do I stay the course on core market cap weighted equity or switch to something like an equal weighted strategy? I have great news. there's a metric literally built for this exact question. Ready for the drum roll? It's called the inverse Herfindahl-Hirschman index.
That's almost as catchy as fiscal is fat.
It's the IHHI, as we call it for short. No, it's basically to measure the effective number of stocks in a portfolio. It's well known, but not by its official name. So apologies for those two gentlemen who came up with the metric. But if you look at the S&P 500 right now, effective number of stocks are sitting at about 44. So the number of names driving your portfolio, even though you're paying for access to 500 plus, it's really just 44 stocks that you could get the same exposure for or two. So effectively quite concentrated by all metrics, and that number's gone down significantly over years. If you look at the top 7 stocks in a portfolio or an S&P 500 portfolio, you're looking at 35% of your weight in just 7 companies, so reasonably concentrated. And as you pointed out, it's not just U.S. anymore. Global markets are becoming more and more concentrated. Taiwan Semi is up there in an EM index. You're seeing double-digit percentage points exposures to single names and what's supposed to be a diversified core passive part of your book. So maybe not so passive of a decision-making process anymore. And it's interesting, over 11, I think the number is at now $1 trillion companies globally now. Back in 2006, everyone thought Exxon was going to be the first $1 trillion company. Obviously, a completely different list that's made it over the milestone. But when we think about concentration risk, there's a second metric, very important, not as aptly named as the first. But we look at average pairwise correlation, which is just looking at how often do those top stocks move together or away from each other, which is going to tell you if something does happen, is my portfolio at risk? Am I going to see a lot of my portfolio drop or rise depending on the macro regime? So do I have all my eggs in one basket effectively? So right now that metric sits at 55%. So the average pairwise correlation for the top 7 stocks in the US market, remarkably low, 55%. So not so highly correlated at the moment. But the big question becomes what happens when macro-y type things happen. So if you were to roll that back to 2022 with the rate rise, the pairwise correlation spikes to 75%. The AI boom, they move in the right direction post-COVID, kind of work from home trade again up into the 70s. So, it's not as concerning right now, but if you're concerned at, an AI bubble or some other big move in the markets, concentration risk may show up at the time that you really don't want it to. So it's something definitely to pay attention to going forward.
That's a really illuminating analysis there, Dave. And I should note that we cover all of these topics in the Outlook. So we're now going to do something we did this time last year with some success, and that's a quickfire round of questions where I'll ask each of our panelists for one non-consensus view about markets next year and beyond, with a very brief explanation if possible. So let's start with you, Sonja.
I would go for a continuation of what I've said last year, although it's definitely more consensus than it was last year. But I think Europe, despite the negative earnings growth, I believe can be driven by the deployment of the money that Germany has announced, but actually hasn't found its way into the real world, which I believe will support risk assets. More specific, I think what governments are buying, again, not necessarily out of consensus, but a good way to find some opportunities.
Thank you, Sonja. Dave?
That's a great question. I'm gonna go further afield, like I think I did last time, because you got the macro specialist here to pick a better metric. So I'm gonna say, sneaky stat is Texas is the largest renewable generator in the U.S. and it's a state about money, as is the U.S. So renewable trends, probably under a different name, picking up in the U.S. next year.
Interesting. Thank you, Colin.
I struggled with this, Max, to be honest. There's obviously many well-known unconventional risks, but it's just they're almost impossible to handicap the odds. Most of them are Trump or geopolitics related. We've got a wide bid offer in Europe, war/peace, potential war in the Middle East, war in East Asia. So some big risks from that standpoint. But I guess more likely there's tariff risk. Fed independence risk is something we're watching quite closely within the fixed income team for obvious reasons, and rule of law. And I guess any of these could get bad enough that they could deliver a fat left tail risk for markets.
Thank you for another sobering set of themes to watch. Colin, Rob.
So look, actually, I'm going to go for two, if I may. So Sonja rightly prompted, and we said this last year, UK real estate has repriced a lot over the last several years and hasn't really moved. We still think it's relatively cheap. So, that's a view we'd maintain. One other thing and we tend to focus more on the longer term because you can't trade private markets, tactically. But one thing that we think is really important and not much discussed, at least in our space yet, is robotics. This is how you get AI off the desk and into the world. And we think that actually this could be really impactful in lots of different ways that frankly we can't predict yet. So that would be one area that we think we're going to be talking about a lot more over the next 12, 18 months.
Thanks, Rob. And finally, Chris.
One for Colin: Scotland to beat Brazil in the Football World Cup in Miami on the 24th of June.
Yep.
But outside the world of pure fantasy, I'm going to stay on the UK and talk about mid-caps a bit. So FTSE 250 trading on 13 times forward earnings. And then a few reasons that you could constructively positive. European and therefore UK natural gas prices have been in the process of collapsing over the last 6 months. UK corporates are particularly sensitive given the amount of gas we buy on the spot market. A little appreciated fact, after the US and China, the third biggest investor in AI over the last decade is United Kingdom, with something like $30 billion of cumulative investment. So, but no one wants to, give us credit for it. And then the pre-budget angst is now out of the way. And we think the most important bit of that mix is the willingness to be very flexible in the maturity of supply demonstrated by the DMO. So if that continues to follow through, then we see some downward pressure on gilt yields and funding costs for UK corporates.
Hey, thank you, Chris. A bit more of a bullish non-consensus view there. Thank you.
Very bullish on Scotland's chance in the World Cup.
So, Sonja, we've covered a particularly large amount of ground just now. What are the key takeaways for investors?
Yeah, Max, it feels that every year we're covering an ever larger aspect, every part of markets, and that the actual factors to consider get much broader. Hence, breaking it down in manageable scenarios and being very clear on the input factors is ever more important. We said on the macro that we do not have a lot of concerns. I love the 222, but at the end of the day, right now, I don't think investors can hang their hat on any major areas that would concern them, that would lead to a major drawdown in markets. We've debated CapEx, and that will remain a major topic, not only because it is vast numbers, but as Chris has rightly pointed out, will that actually lead to relevant payback, and will this be worth their while for the companies that are issuing it? Let alone the concentration risk that we're actually dependent on 4 companies getting it right, because the vast majority of the CapEx is linked to the so-called hyperscalers. Following on, and that's the point that Colin made, is the enormous amount of issuance. And we focus very much on the corporates, but it's likewise from governments around the world. We will see a net increase in net new issuance. And again, there is a lot of capital around, but that, of course, competes with private markets as well, because we're looking for an enormous amount of money to be placed. And then last but not least is the fiscal concerns that all of us have raised, and that again not necessarily will be a major issue in 2026, but it clearly will create further headlines simply because we are dependent on AI in particular paying off in order for governments to get their books in order. And there you can see the interconnectedness of all of these issues, which might well not be the driving force of markets in 2026, because I think this is what we've realized in 2025, that despite all the chaos that unfolded post-Liberation Day, that markets were incredibly resilient on the back of the resilience in the economy and the fact that most central banks were able to ease, at least to some extent, which supported equity markets and, of course, risk assets in general. So we're entering 2026 on a relative calm. We did the same in 2025, as you recall, where we said, yes, the market so far has only priced the positive of the Trump program, and we were waiting for the negatives to come out. We weren't disappointed. Scenario analysis and being very clear on how the individual goalposts will influence markets is the best way to make sure that incoming data points and facts can be put in the right context.
Thank you, Sonja, for that summary. I do have a slight sense of deja vu. and we can return this time next year just to see whether it's justified. Well, that leads us very nicely into our final segment, which is where I ask you all what you're planning to watch, read, or listen to over the festive period. I'll kick off and say I've just started reading Noble House by James Clavell. He's wonderful. It's great. I'm listening to the audiobook and it's 50 hours. So I'll probably still be listening to it when we gather again next year. Let's start with you, Rob, and then work our way around the table.
Okay. So I was having a look through my library. Actually, I'm rereading When the Money Runs Out by Stephen King. This is actually an old, not as in the Carrie Stephen King, the ex-HSBC economist Stephen King. This is 2013 now. It's not lighthearted. It's pretty bleak, but his description of how behaviors change when the focus shifts from wealth creation to wealth distribution is, I think, still really relevant. When I get to the end of that, on a lighter note, I'm sure we're going to watch Home Alone again as a family for the 20th time.
It's a classic. Thank you, Chris.
Yeah, I'm going to go with an underappreciated Christmas film, and you may think I'm about to say Die Hard, but I'm not. I'm going to say Gremlins. Often unacknowledged as a Christmas film, but includes some important advice for this time of year, such as don't eat after midnight. But when I've finished watching Gremlins, I will be trying to work my way through Chip War by Chris Miller. It's about the struggle for dominance in the semiconductor industry.
Thank you. And Sonja?
I'm not reading any of these, although Chip War I have read. So just to make sure that I'm not just watching. But I will continue. And I did listen to our episode last year, and I will say it again. I'm always watching The Grinch, the animated one with Benedict Cumberbatch, and I'm sure that was a given because my colleagues know me so well. But I'm actually watching, and again, I might be out of date, but the Federer 12 Final Days documentary is, I think, really fascinating. And with my daughter, I'm watching now Grey's Anatomy, which is a lot of déjà vu because I've been watching it when I was pregnant with her.
Okay, lovely. Thank you. Dave?
Let's see. Yeah, Christmas is easy. I got young kids, so the Santa Claus. I don't know if it's popular here. Tim Allen, the Santa Claus series. Yeah, pretty classic. 1, 2, and 3, all right in a row, marathon. They get worse as you get to 3, I think. And then what on the reading list? I do this. I actually do this every year. Not always in December, but I'm doing it right now. Art of War, but narrated as an audiobook by Aidan Gillen, is very, very solid. It's a nice listen. So
he's the guy in
Game of Thrones.
Game of Thrones. Okay,
yeah, correct.
Yeah,
okay.
It's
just
right.
It doesn't put you to sleep. It's nice. It's a nice.
Okay. Yeah. Thank you, Colin.
So it's a book, Max, and I'm going to be buying an extra copy for Chris because it's great moments in Scottish football. To which we'll be obviously adding our historic victory over Brazil next year.
Is it a very short book?
Yeah. Okay. Thank you. Enough. You've had your shot. So more seriously, actually, and on the subject of all things debt, I got a great recommendation from a colleague in our Chicago office. Health warning: this isn't a festive feel-good recommendation by any stretch, but it has an incredibly catchy title. So, audible intake of breath. It's The Rise of Carry, the dangerous consequences of volatility suppression and the new financial order of decaying growth and recurring crises. Just rolls off the tongue, doesn't it? That said, I'm actually thinking of making this required reading for the team. It's an absolutely fantastic read for today's markets, I think.
Brilliant. Well, that's our usual eclectic mix of highbrow and other types of content for our listeners and clients to get their ears and eyes into over the holidays. And that's a great point on which to end today's call. Thank you, Sonja, Dave, Colin, Rob, and Chris. And thank you to you, our clients and listeners, for joining us. You'll be able to find our global outlook on our website and see our other updates on our social media channels, our blog, and of course, here on our podcast. From all of us here at L&G, we wish you and your loved ones our very warmest season greetings. May 2026 bring you joy, prosperity, and many cherished moments with those you hold dear.
As a reminder, this podcast is intended for investment professionals only and shouldn't be shared with a non-professional audience. The views expressed in this podcast are those of L&G's Asset Management Division, as at the date of publication. This podcast is for informational purposes only, and we're not soliciting any action based on it. The information discusses general market, economic, or political issues, or industry or sector trends. It does not constitute research or investment, legal, or tax advice. It is not recommendation or advertisement to buy or sell securities or pursue a particular investment strategy. Assumptions, opinions, and estimates are provided for illustrative purposes only. There is no guarantee that any forecast made will come to pass. No party shall have any right of action against L&G in relation to the accuracy or completeness of the information contained in this podcast. Where this podcast contains third-party information, the accuracy or completeness of such information cannot be guaranteed, and we accept no responsibility or liability in respect of such information, not for distribution to any person in any jurisdiction where such distribution would be contrary to local law or regulations. Copyright 2025. Legal and General Investment Management Limited is authorised and regulated by the Financial Conduct Authority. Unless otherwise stated, references herein to L&G, we and us are meant to capture the global conglomerate that includes, in the European Economic Area, LGIM Managers Europe Limited, authorised and regulated by the Central Bank of Ireland as a UCITS management company pursuant to European Communities Undertaking for Collective Investment in Transferable Securities Regulations 2011 as amended, and as an alternative investment fund manager pursuant to the European Union Alternative Investment Fund Managers Regulations 2013 as amended. In the USA, Legal and General Investment Management America, Inc., a US SEC regulated investment advisor. In Japan, Legal and General Investment Management Japan, KK, a Japan FSA registered investment management company. In Hong Kong, issued by Legal and General Investment Management Asia Limited, which is licensed by the Securities and Futures Commission. And in Singapore, issued by LGIM Singapore Pte Limited, company registration number 2022318766W, which is regulated by the Monetary Authority of Singapore. For full terms and conditions, please visit our website. To find more content, you can check us out on LinkedIn or on our website.